Hey everyone, welcome to today's Tech Talk with David Blake, CMT from MarketEdge.com. My name's Rachel, and today we're going to review last week's stock market activity, focusing on a technical analysis perspective. David Blake, how are we doing today?
I'm doing well. Thanks for asking.
Awesome. Let's jump right in.
Okay, well, last week we actually had a good week with the markets really surging ahead on more of a dovish Powell Federal Reserve comments. But just to step back a little bit, investors were kind of cautious going into last Friday. They knew that we had Powell's speech coming up at the Jackson Hole Economic Symposium, and everybody was kind of hoping that he was going to be a little bit dovish and not do a hawkish cut. But I think he hinted that we're probably going to get that rate cut in September now. It appears right now that the Federal Reserve, they have the two mandates, and one of them is that they want to keep full employment, and they believe now that the employment situation is weakening a little bit more than they thought earlier. So if they can get a little bit of a pop or a little tick higher in inflation, they're hoping that's going to be basically a one-time thing or a month long, and then start to pull back again. But they don't want to let the jobs situation start to deteriorate. That's a little bit harder to stop once that happens. But anyway, we had the Dow Jones made a new high on Friday, which is something they last time it made a new high was back in December, I believe. I said in the letter that the S&P 500 also made a new high on Friday, but it was actually 2 points shy, and it made a new high earlier in the week. We also had the NYSE; it made a new record high. So what that is telling you is that we are seeing more of a broadening out of the market, which is what we've been looking for. Now, we mentioned several times that there was a little bit of a rotation out of the big cap technology and Mag 7 and AI related stocks here over the last week or so. And in fact, going into Friday, the NASDAQ had fallen 522 points or 2.4% from the prior week's close. And then on Friday, with the big rally, we almost erased that deficit, which was good. Now, one thing I do want to mention is that despite this rotation that everybody's talking about, don't think that the big cap and the Mag 7 are not going to respond to lower rates also. They'll catch fire here again pretty soon. And I don't think that this rotation is something that you want to say, I'm going to go out of these and look at more industrials or bank stocks and health stocks. You still want to hold on to those if you have them. You just want to maybe diversify your portfolio to include some other industries or sectors. So again, on Friday, we had after Powell's speech, we did see the treasury market and the yields slip down a little bit. They had gone up earlier in the week because midweek we had a little bit of inflation data that came out that was a little bit hot. But just the fact that Powell said that they're pretty much on board for a September rate cut, that brought them back down on Friday, which helped boost stocks. We did see a little bit of a move higher in crude oil prices last week. Actually, they got up to a 3-week high, and they're higher again today. A lot of that is because of the geopolitical risks, not only in the Middle East, but the Russia-Ukraine thing isn't falling into place the way that Trump hoped it would. So we'll have to see how that plays out. But as long as that tension stays there, oil prices are probably going to keep nudging up, at least into the 65, 66 area. I think they closed last week at 63.82. So at the end of the week, we had two sectors that were down. That was technology and communication services. Nothing big on those, but every other sector was higher, and the gains were led by energy, REITs, materials, and financial. They were all up more than 2%. So after the big rally on Friday, we did see the Dow Jones, S&P 500, and Russell 2000 up for a third consecutive week, and I think 4 of the last 5. But the NASDAQ wasn't quite able to erase the losses from earlier in the week. It was off a few points, nothing big. I think it lost 126 points, or just about 0.5%. Nothing to get too excited about. So it's kind of a funny week after that big rally. I did mention that when you have a move like that where we're up 900 points in the Dow or something like that, you need to consolidate those gains. You have some back and forth filling going on. But we have tomorrow, we have durable goods orders will come out. That won't be a big market mover, but it will tell you how the economy is going along. Wednesday is a big day. We're going to have NVIDIA report earnings after the close. That could be a market mover. If they, I don't think they're going to be blowing away the earnings because they've had some pauses in here with what they could ship to China. but I don't think it's going to kill the semiconductor or tech sector. But I wouldn't be surprised to see NVIDIA get a little bit of a pullback after they report their earnings on Wednesday after the close. In fact, today the only two stocks in the Dow that are up are NVIDIA and Nike. So people are kind of nibbling away at it. And then on Wednesday and Thursday, we have a lot of retailers reporting. That's going to see how the consumer is going to do. We have Abercrombie Fitch, Kohl's, Five Below, Urban Outfitters, Best Buy, Burlington, Dick's Sporting Goods, Gap, Ulta Beauty. A lot of those stocks are all coming out this week. That's quite a bit. So that'll tell us the kind of the shape of how the consumers is holding out here as we get a little bit more of a tick in inflation. And then the big report again is Friday. Now, you're going to probably see the PCE comes out on a July PCE, and that's basically the Fed's prime gauge for what they want to do with rates. But they are expecting things to maybe just tick a little bit higher. I think the headline PCE is expected to rise about 0.2% from June. Core PCE is probably going to be up about 0.3%, but it's also, they're looking, I think, about 2.9% year over year, which is hotter than what they're looking for. But as Powell said, they're hoping that the stuff on the tariffs is going to be kind of a one and done type of situation where maybe we have a little bit of August and part of September from the tariffs where we see a little bit tick higher in inflation, but then we start to fall off towards the end of the year. If a big surprise higher or lower by the PCE, again, could probably move the market. If things came in much hotter than what we're looking at, that 0.2 or 0.3, then you're going to get people questioning again whether a September rate hike is still on the table. So that'll be a big number to watch on Friday, and it should be a market mover. Okay, as far as the technical condition of the broader market, it did improve as we were making new highs and saw that rotation out of the tech shares. We also saw the equal weight S&P 500 post a new high last week, which that's also kind of a confirmation of a broadening in the market rally. So that was something that we like to see. Momentum, it continues to strengthen. MACD, though, is mixed. We didn't get a bullish cross yet on the NASDAQ, but the NASDAQ is higher today. And we look at the FLDs to confirm whether we've had bottoms in the cycles or not. And it looks like with the NASDAQ, we actually needed to see it kind of bounce here off of the 40-day FLD, and we're getting that today. So that's a good sign. Another good sign for the market going forward is that we like to see some of the secondary indexes outperform the Dow Jones and S&P 500. And last week we got that also. We had the Dow Jones Transportation Index was up 3.1%, and the Russell 2000 was up 3.3%. And in fact, the Dow Jones Transportation was able to test support at the 50 and 200-day moving average, so that was good. We also saw the Philadelphia Semiconductor Index, which was kind of flat last week, but we did see it come down, bounce off of the 50-day moving average. So the key support levels that we want to watch are holding here, and that's a plus for the market going forward. Okay, as far as underlying breadth goes, I want to go over here just to show something. We often talk about the positive and negative divergences. We consider the NYSE AD line. We'll look at this over here, a leading indicator of market direction. And I think if you take a look at this, you can obviously see that it's making a new high, confirming the strength of the Dow Jones. So this is something that you want to see. It made a new high on Friday. That's, again, just confirmation that the market probably is going to move higher. And then despite the NASDAQ finishing lower last week, what we saw towards the end of the week was a nice big jump in the AD line, which means that they're coming back in and broadening that out. We also saw a broadening out of the new highs and new lows. They were contracting a lot, to say the least. In fact, the week before, or 2 weeks ago, we had on the NASDAQ, we had 427 new highs on that Wednesday to 88 new lows. And then this past Wednesday, that had gotten all the way down to 82 new highs to 141 new lows. So that was showing some negative divergence. But then on Friday, we had 374 new highs to 56 new lows. And I had mentioned that the NYSE had zero. It had only 193 new highs, but I said zero new lows. But after the close, something ticked lower. So they did have one. And the last time that actually happened was in February of 2021. So we're getting some expanded leadership, which is something you want to see. We also saw the VIX make a new low for the year, got down to 1422. That's telling you that the traders aren't real concerned right now that we're going to see something upset the market and it could trigger a deeper sell-off. The only thing you want to watch about that is that you don't get too complacent. When it starts getting down around 10 or 11, something like that, sometimes traders can be a little bit too complacent. They don't think anything's going to go wrong. And when people get too complacent, that's usually a little bit of a red signal that you want to watch. As investor sentiment, we're still seeing some divergence in that. Retail clients are still a little bit nervous in here. They're still below historical average. A lot of times when the market's different indexes are making new highs, you start seeing the retail and some of the other people getting a little bit excited, and you'll start to see these numbers get a little frothy. We're still not seeing that. Again, as far as the American Association of Individual Investors goes, they saw a small uptick, but the retail bulls are still below 37.5%. They're down somewhere around 30.8. So they're still way below, almost 25% below their historical averages, which means that there's not any froth on the retail side. Now, as far as the hedge funds and the professionals go, we did see a nice big jump in the National Association of Active Investment Managers Exposure Index. That jumped all the way up to 98.2%. So they're almost fully invested. They're not on margin yet, but close. I mean, they don't have much cash in there that they're holding right now. That's something you want to watch when up to where they're fully invested. And sometimes you'll see the market slow down just because if they're fully invested, who's left to put more money in the market. So that could mean that the gains as we're going through the seasonal week time here, you may see the market kind of floating, a little up and down and not a lot of action one way or the other. And finally, I did want to mention that we did get July margin debit balance at a new record high again. And that's, again, a red flag that you want to watch. The reason for that being is if we do get something that upsets the market and all of a sudden we have more of a pullback than what people were looking for, all of a sudden you start to get margin calls, and margin calls are forced selling where they have to sell stuff that they don't want to. And then that makes the market more susceptible to a steeper sell-off. So it's just something to watch. I don't like to see that margin debt, making all-time highs when the market's making new highs, but that's just something that's not normally going to happen. So we'll kind of watch on that. Just to wrap it up again real quickly, the CTI is bullish. We talked about it the last couple of weeks where the August 1 was probably the low trial for these cycles. And we went back and of course we reset the next week. So we reset the A and B to a positive going back to the week right after the week of August 1st. And we're looking to probably stay bullish for another, probably into September here a little bit. Like I said, I don't, because of the seasonality, I'm not looking for more moves like last week. I think ahead of this PCE report on Friday, I don't foresee investors really just jumping in with reckless abandon because they think a rate cut's coming in September, because the PCE certainly could stall that a little bit. And then again, we're going to have the CPI and PPI coming out the second week of September, which is going to be before the September FOMC meeting. So it's not a slam dunk that we're going to have that. It's a very probable. And in fact, I believe we're at about a 90% or 88% probability from the CME FedWatch group that we'll get that rate cut. And most analysts are looking at in brokerage firms. But like I say, it's not quite a slam dunk because we do have 3 or 4 key inflation numbers coming up. And again, I think you'll also need to watch the August employment report that will come out the following week, just to make sure that the jobs market isn't falling out of bed. So again, well, let's kind of watch the retail earnings this week. We'll watch the NVIDIA. That's going to be a market mover. And then on Friday, the big one is the July PCE. And that should set us up for the week.
All right. Thank you very much. You can go to marketedge.com to get daily technical analysis on over 4,000 stocks and ETFs. Check us out at marketedge.com. Thanks so much, David.
All righty. Bye.
Thanks. Bye.